So let's get started talking about Bollinger Bands. Now, a couple side notes. Tonight in the class, I'm going to have a couple prepared video presentations that I will input into the class. If you would like to see these separately, if you go to YouTube and look for the channel, not a search for words, you want to look for the channel which is called Forex and CFD Education. And then look under the playlist for Bollinger Bands, and you'll see all the recorded segments that I play in tonight's webinar. Because the webinar, when it records, doesn't record over top of copyrighted materials. So you have to see the original materials for that. But you'll see them tonight, no problem, in the presentation. Also, if you look on your screen, you see a handout. Tonight I've got for you the ETS Capital Technical Indicators Guide. It's a nice little guide that tells you about some of the major technical indicators. Now, this handout is only available in this live class. If you're watching the recorded version, you can't download it. So if you want, please click on that little download button you see on your screen and download it to whatever device you're using, and then you can move it around all you want later. If you don't, you contact customer support, and they will locate it and send you a copy. Now, in tonight's class, I'm going to use the term security, but I might also use the term asset. I might use the term Bitcoin, or I might say euro, I might say gold, or I might say oil. In no case am I talking specifically about a specific asset. I'm talking about all publicly traded financial instruments in which an open market exists. So we're talking about all assets that you could trade on the ETX CFD platform. But it just gets very, very boring saying the word security, security, security over and over. You get tired of it, I get tired of it. So I just say whatever word I want to come out. Like we'll be using the euro US dollar chart for a demonstration, but what we're talking about there will fit on anything that you're trading. Similarly, I intermix the terms investing and trading. We're all ETX members, and ETX is a trading platform. It's not an investment platform. Okay? And we know the difference. Trading is a short-term function to make profit on small moves in the market, where investing is something that's longer term. But again, I mix up the terms in class just so I don't get bored and you don't get bored. Now, tonight we'll be talking about Bollinger Bands, which falls under the field of technical analysis. Now, Bollinger Bands falls in the field of a technical indicator, but the biggest field is technical analysis. And a lot of us hope that technical analysis will tell us, should I buy today? What will the prices be in an hour from now, tomorrow, next week, next year? Wouldn't investing and trading be easy if we knew the answers to these seemingly simple questions? But I don't have a Ouija board and I don't have a crystal ball, and neither do you. So if you're attending this class in the hopes that technical analysis and Bollinger Bands has the answers to these questions, I'm afraid I have to disappoint you early. It doesn't. However, if you're attending this webinar with the hopes that technical analysis will improve your investing and trading, I have good news for you. That it will surely do. Now, Bollinger Bands is a very interesting indicator. First of all, it's one of the few indicators that's actually dropped over top of price action, not placed below the price chart. That's something that makes it interesting. But the other thing that attracted me to Bollinger Bands a long time ago is the fact that they were developed by John Bollinger, hence the term Bollinger Bands. But it wasn't that John Bollinger developed them. It's the fact that John Bollinger is still alive and active in the markets. And he operates his Bollinger Band site. It's one of the few indicators that you can actually go back and get the information and how to use it directly from the horse's mouth. Now, there's been an abundance of information published on how to trade with Bollinger Bands, but most of it is discretionary in theory. You have Joe Smith out there telling, well, if you use Bollinger Bands this way and this way and this way and use it to calculate this and this, you make a trade here. You know, that's discretionary. You have all these gurus who are trying to preach you their little interpretations of Bollinger Bands. But the how to use Bollinger Bands information usually pushes it back to the trader to interpret what the security price is doing relevant to its bands. So in order for us to understand how to use Bollinger Bands so we can make our own decisions and understand what it's doing, is we have to understand what it comes from. It's the only time that you'll have to ever deal with the mathematics of what or how to calculate these bands, because they're automatically dropped on your screen. There's nothing you have to do. But in order to know that they're doing it correctly, the market isn't doing something haywire at the moment, you need to understand what's causing these bands, where the mathematics come from, and how you can see the flukes or the false signals. So as I said earlier, Bollinger Bands can be applied in all financial markets, including equities, forex, commodities and futures, and almost all time frames. So Bollinger Bands is one of the few indicators that is actually quite accurate in small or short-term time frames like we trade. Now, Bollinger Bands answers a question. Are prices high or low on a relative basis? So, by definition, price is high at the upper band and price is low at the lower band. That bit of information is incredibly valuable. So, before we go on, let me show you these on a real live chart so that you understand what we're talking about, because I don't want you to get lost. So, Bollinger Bands looks like this. It's in a field of called envelopes or bands. It makes a band around price. And we have what's called the upper band and the lower band. Those are those dark green bands I put on there. The pale green, the background there, the transparent part, is of very little consequence to Bollinger Bands. It just seems, it lets you fill in and see things, see the bands better, but it has very little to do, or it has nothing to do with making any interpretations. Neither does the shape of the bands. Sometimes it'll look like a worm. Sometimes it'll look like an alligator. I've seen ones that look like aliens from, space movies. Doesn't make a difference. Now, the width of the bands, the distance between the upper and the lower band, do tell you something, but the shape doesn't. But this is what a Bollinger Bands would look like on a chart. Now, Bollinger Bands starts off with a 20-period simple moving average. And this is, let me darken it up so you can see it a little better. This is this price band, or this moving average band that's on the chart. It is a plain, simple moving average based on a 20-period moving average. Okay. If you don't understand what a moving average is, we're simply taking the close price of the last 20 sessions, adding them together and dividing by 20. And as you notice, it kind of follows price. Now, this is just the first line of Bollinger Bands, because it's not a moving average strategy. It's not a variation of a moving average. This is just the first band of the calculations. Now, you have to remember that every technical indicator, no matter which ones they are, there's all different types of formulas that can be applied, but there's only basically 5 numbers that it can be applied to. So almost every indicator uses the same numbers. It's the open, the high, the low, the close, and volume. Okay. So most of them function simply on the close. Some relative, take the highest minus the lowest. Some take opens and closes, but they're all the same number, every indicator out there. It's what you do with those numbers, whether you divide them and jump them up here and divide them over and roll them over and push them into the same, but it's all the same numbers. They're just being massaged differently. So in this case, we start out with the 20-period moving average. We then calculate, and we're going to go over because this is going to be a difficult piece of math for you. But we're going to calculate what's called a standard deviation. Now, a standard deviation is a statistical formula that measures a set of data against its average or its mean. And we'll go with that in a second. But once that's done, we then drop on 2 standard deviations plus and 2 standard deviations minus on the basis of what the price of the moving average was. And these become the upper and the lower band. And this forms the entire Bollinger Band. So let's go back to my presentation, and we're going to talk about actually, before we go back to my presentation, I'm going to share a little video and a little presentation with you that explain this in a little bit more creative format. Uh-oh, not sure if I have the right one here. We'll see if this is the right presentation. If not, then I'll just explain it all to you. Okay, I don't have the little right video up for you, so I'll explain it to you. So Bollinger Bands are a technical analysis tool. Specifically, they are a type of a trading band or envelope. The trading bands and envelopes serve the same purpose. They provide relative definitions of high and low that can be used to create rigorous trading approaches and pattern recognition. Now, Bollinger Bands uses this statistical formula that's called standard deviation. Now, interesting, in the real world, no statistician would ever calculate standard deviation by hand. The calculations involved are somewhat complex, and the risk of making a mistake is very high. So, standard deviation is a measure of dispersion of a set of data from its mean. Mean being the average. It is calculated as the square root of variance by determining the variation between each data point relative to the mean. If the data points are further from the mean, there is a higher deviation within the data set. That's a big lot of words, isn't it? So, in its simplest form, the mean is simply the average of the data points in the given set. In investing, for example, you might want to know that the mean closing price of the last 20 days, or a simple 20-period moving average. Now, this means the calculation is always taking into account the most recent sessions, and older sessions drop off as they're irrelevant. So standard deviation is calculated based on the mean or the average. The distance of each data point from the mean is squared, summed, averaged to find the variance. Or, to put it another way, variance is derived by taking the mean of the data points, subtracting the mean of each data point individually, squaring each of the results, and then taking another mean of these squared. Standard deviation is simply the square root of variance. Okay? Could you calculate that? Could you figure it out? Do you know what it means? Nope, neither do I. Okay. But if you actually want to find the standard deviation of anything, if you're using an Excel worksheet, you just use the Excel formulas, and it's got the formula built in for standard deviation because it is a globally renowned mathematical statistical formula. So Bollinger Bands are based on the middle band is usually, and you're going to find all types of gurus out there trying to tell you use an 18 moving average or an 18 base or a 22 base, or I use it. John Bollinger developed it, tested, it's been tested for 50 years using a 20 base. Now you can adjust Bollinger Bands. You can use a 2.5 standard deviation, which will give you less signals, less information. But if you want less false signals and more slower information, you could do that. But I never adjust an indicator from the developer's formula because I believe that those are what's tested. Because if I want to use a 2.5 standard deviation, I'd have to test it, back test it, and understand it entirely to make sure that it just isn't just my brain that's saying, oh, this is a wonderful thing, and it doesn't really work in the markets. Then the upper band of the Bollinger Bands is spread above the moving average by a volatility measure known as standard deviation. And for Bollinger Bands, the default is set at 2 standard deviations. The lower band is the exact opposite. It is the middle band less the same volatility measure. So let's go back over to my chart for a second. So what we have here is our moving average, 2 standard deviations up, 2 standard deviations down. So 2 standard deviations added to the moving average and charted here. 2 standard deviations subtracted from the moving average and charted below. So that tells you the band is equal distance, the upper and lower, from the moving average. And for Bollinger Bands, the only thing we're looking at is the upper band, the lower band, and the moving average. That's it. Like I said, we don't have to have this transparent area, except it makes it easier to see things. Now, it is said that everything and anything you need to do and understand about an asset is contained within the bands. The bands will help you set your entry and exit points. It'll help you see whether it's trending. It'll give you buy and sell signals. So that gives you everything you need. But of course, like all indicators, it should never be used on its own. Uh-oh, let's get me to the right page here. So there are 3 primary uses for Bollinger Bands. There's pattern recognition. That means recognizing double tops, double bottoms. There's reversal signals, which identifies early warning signals of reversals. And then there's trade analysis, which will help you detect continuations and conclusions of trends. So the pattern recognition, is one of the most popular patterns for trading. Is called the M and the W pattern in Bollinger Bands. And this takes a while to develop, so it's like trading a head and shoulders. It has to develop all of its legs before it actually tells you anything. So we can see if we're starting off with a downtrend, we're going to go down and we're going to form the first leg, which means the price comes down and hits a bottom. It bounces off that bottom and moves up to make the center of what we would call the W. We won't recognize it now. It's too early. Price bouncing up and down happens quite often. It's then going to form the third leg of the W. We call this in Bollinger Bands the N formation because it's either going to make an upside down N or a right side up N. It's at this point when it bounces off the second bottom and that N is completed that we might recognize something. Because as you can see, it takes a lot of time frames. Even if we were looking at a 10-minute chart, look at all those candles that would have taken place before it actually gave us a signal. When it bounces off the second bottom and starts forming the final leg, we would get a buy signal in this case when it made the final leg and crossed its moving average. And we would set an equidistance to the beginning of that trend as our exit point. This is where we would set our profit level. So when we're doing our risk management, we would look at that to set our profit level. And we would put our stop loss at the bottom of at the level of the bottom. So now what we got is where to put our stop loss, an entry point, and where we would expect it to go so that we can calculate our risk-reward ratio. Now, the W is formed coming off of a downtrend. The opposite is the M formation, which comes off of an uptrend. It still makes the same legs, but they're just mirrored images of each other. Same rules all apply. Okay. In this case, the first three legs forms a right side up N. In the other, when it's coming off of an uptrend, a downtrend, it forms an upside down N. So the N is the key to note, or is the important thing that we need to notice, because that's when it's setting up the trade. It's saying to you, okay, we might have something happening here. So a bearish top is formed by two successive tops in price, which is opposite of the W, form the M. So they're just mirror images. Before forming the entire M, an N will emerge in the price action, and this is the point at which traders should want to get involved. So this will work very well with other indicators such as RSI, because Bollinger Bands doesn't give you overbought and oversold indicators. So having an additional indicator like RSI works very well. So we highly recommend combining the Bollinger Bands with the RSI indicator. It's a perfect match. Now, Bollinger Bands also gives us two different kinds of top formations, which are also the exact opposite in downtrends. But during trends, the moving average holds very accurately, and a break of that moving average is usually a meaningful signal that the sentiment has shifted. So when we see the break of the moving average, see, we're coming off of a downtrend. Now, price can bounce off of that, but when we see it bounce off it and breaks the moving average, it's telling us that the sentiment of the market has shifted. And as we can see, the asset moved into the uptrend. And this is what we call riding the band. Then we can see that what we want to do is also watch. Each time it makes a new high, we want to see it come up and touch that band. If it can't reach that upper band, it's telling you that high or the trend doesn't have the legs that it should have. And down here, see the price was rejected and it fell, and then it broke the moving average and then moved into a defined downtrend. And all of this is happening within those bands using that moving average. So while Bollinger Bands are exceptionally helpful in determining when an asset is overshot to the upside or downside, it's important to use the bands to also set risk conditions, not just entry points. Additional risk and reward should be set based on the width of the bands. Now, the wider the bands, like I said, it's not the shape of the bands, but the width of the bands tells you the volatility in the market. The wider the bands get, the more volatile the market is. The narrower the bands get, the more contracting the market it gets. And there's actually a strategy called, what's it called? I forget what it's called. But it's when the bands get very contracted and get very close together, you can watch for a breakout because sooner or later price has to break up or down. And when you see that price break from that congested little narrow band, that's telling you that there's a trading opportunity. So let me show you a presentation on how you would set up a trade with Bollinger Bands. Now, you might have to turn your volume up a little because I've got mine playback volume turned So as you can see, there's many ways that you can apply and use Bollinger Bands. They're not very complicated, but they do take a little bit of time to master. Now, as I mentioned earlier, the simplest strategy is called the Bollinger Band squeeze. The one I couldn't remember the name of the strategy. It's the Bollinger Band squeeze. And it's a pretty straightforward strategy that is relatively simple to implement. In fact, it's so simple that people think it doesn't work. But ultimately, all we're ever looking for is a high probability trade. We're looking to filter out all the other trades and only end up with high probability trades that simply give us success, because the rest is all about risk management, setting your stop loss, your take profits. So the Bollinger Band squeeze is pretty simple. First, we look for security with narrowing Bollinger Bands and low bandwidth levels. Okay, ideally, we're looking for something that's really contracting. We want this narrow little band. Then we wait for the band break to signal the start of a new move. An upside band break is bullish, while a downside band break is bearish. Note that the narrowing bands do not provide any directional clues. They simply infer that the volatility is contracting and is really contracted, almost like when we use a triangle. We know as price gets closer and closer to the apex of a triangle, it has to break out. Now, it could break up or it could break down. So what we're looking for is when the bands are getting narrower and narrower, that means the price is pulling together, and then we're going to look for a breakout of the band, and then we would take the trade in the direction of the breakout. So you want to keep your eyes very close on the band. So as the band's narrow and the price and the bandwidth declines to a lower end of its range, the price plunges below the lower band. When it does that, it's giving us, in this case, a sell signal. So even though the Bollinger Band squeeze is straightforward, chartists should at least combine this strategy with basic chart analysis to confirm signals. For example, a break above resistance can use to confirm a break above the upper band. Similarly, a break below support can be used to confirm a break below the lower band. Unconfirmed band breaks are subject to failure, but we simply have to look at the band break, and one of the keys here would be volume. If price breaks out either up or down and you see volume increasing, that means that asset has picked up the momentum to go. If volume hasn't increased, then the traders aren't supporting that breakout, so it's most likely a false breakout. So as you can see, the Bollinger Bands are a multifaceted trading indicator that can provide you with lots of information about trends, buyers, and seller balances, and potential trend shifts. Together with the moving average and RSI, Bollinger Bands make for a great foundation for a trading strategy. Now, before we go, I'm going to share with you a little quick, easy Bollinger Band strategy. Now, what you're going to be seeing are going to be several screenshots in a row, and the instructions, the step-by-step instructions, are written on the bottom of the chart as you're watching them. So, ladies and gentlemen, on that note, I'm going to say goodnight to you. Now, that little presentation on the strategy is also in that YouTube channel that I showed you earlier in the presentation. And again, if you look under Bollinger Bands, you're going to find, and then you can copy that or watch that as much as you want on that little step-by-step presentation. So thank you very much for joining us tonight. Have a great trading week, and thank you for supporting ETX. And have a great holiday season. Bye now.